All right, last thing here today, guys. Market trash that makes cash. It's something we've been doing each and every Monday, and kind of set up the segment and talk about it, and give us some of these trash picks that you got here for today, Marky.
All right, so trash that makes cash. We analyze stocks that are under $5. And the interesting thing about stocks that are under $5 is that they can come in all kinds of market cap sizes, and and this is an area of the market that I follow religiously, and in this under $5 realm, the micro cap companies, stocks that have a market cap under $250 million, they've been getting hit hard. Whereas stocks that are traditional small cap companies in that 500 to $1 billion valuation, 500 million to a $1 billion valuation, there's been a separation in performance, and this probably linked a lot to ties to the rut and actual small cap space. And then, of course, you have like a few, and this was on the stock and option report. I want to bring it up again. AUY, who has a market cap of like $4 billion. So one of the things you learn in evaluating stocks under $5 is that, yes, we like to call trash that makes cash. Some stocks under $5, just because of the amount of shares they've issued, if they had 10% less shares, if you cut their shares by, double, AUY is like $9 or so. The market cap on AUY is actually very, very big. And, in looking ways to play gold, and AUY has been it's been a favorite of mine for a long time now because the options are so liquid. But it had a nice little technical setup heading into the week. And so it is under $5, but it is not a micro cap. It's not even a small cap. AUY, Yamana, I never pronounce it right. How do you pronounce it? Yamana Gold, a nice mid cap company. So happens to be cheap, but that doesn't mean it's in the micro cap thing. It just happens to be cheap due to the amount of shares they've issued, but it's a nice mid cap company. Clear technical signal. Matt, how would you play this stock given your dollar analysis combined with the gold analysis?
Well, the dollar analysis is going to play out while AUY is underneath the breakout channel. And so the dollar analysis is going to play out down here on the snapback retracement. And so that dollar analysis will actually play out. If the dollar analysis is correct, then that holds here. And then as that analysis gets strengthened, it breaks 472. And so the dollar analysis just stabilizes this chart to form a higher low, thus putting pressure on the horizontal breakout. And so it's a very similar analysis, Mark. And if you don't mind, can I do mine? Because it's a similar analysis. Mine is HMY, Harmony Gold. And the only difference, honestly, is HMY versus AUY. like both of them pretty big companies. But it's a very similar analysis here. So in terms of the difference in Harmony versus AUY, and I think AUY is the stronger candidate than HMY. I think both of them fundamentally are fine. I've looked into both HMY and AUY. There's nothing concerning about their companies at all. Actually, both have pretty good valuation. I would compare both of these companies, like Harmony's forward P ratio is 8.7, its P ratio is 12.81, price to books 137. Like those aren't numbers you're going to scoff at as a fundamental individual. And so AUY, very similar. So fundamentally, they're both fine. And again, not all stocks under 5 are trash, pink slip, get them out of the door, like just never talk to them again. There's a lot of these stocks that are 4, 5, 6, 7, $8 billion market cap companies, right? I mean, we have categorized as a society stocks under $5 are penny stocks and thus trash. And that's why we call it trash. But there's been stocks that are extremely liquid, write covered calls on for many, many, many years. Sirius Radio would be the one that was under $5 for years and years and years and years. But so not everything under $5 is in that what we would traditionally consider trash. But when you're looking at Harmony, when you're looking at AUI, the same analysis is both market caps fairly decent, both PE ratios have very good valuations. And for me, a lot of these gold plays, whether you're talking the big dogs like Newmont and Barrick Gold, or where you're talking about your, smaller companies like AUY, HMY, I have a feeling that if one wins, they all win in the short term, and then it separates over time. The strength separates themselves over time. And so I don't think there's going to be a radical difference in short-term analysis on HMY versus AUY, although I would put HUY's breakout as a little bit better on yours. So AUY, that the breakout on AUY is really lined up very good for that dollar analysis, Mark. And so on that dollar analysis, you would let that just kind of play out here, let it build into the strength, and as it broke, that's when you're looking to take action here. On HMY, I think you can be a little bit more aggressive, and that's a little bit due to the strength in the short-term trend and then the underperformance in its downward movement and pressure. So a little bit of a combination happening on HMY, but what is happening, what that allows is if that dollar analysis plays out and we see the violation of that dollar analysis, Mark, you could see a scenario where you find a good support right here on the 20-day moving average. Maybe you get your doji here, maybe your slowing momentum candle with a really good retrigger above 4.6. And so currently with HMY, I feel like if the dollar, to answer your question, I feel like if the dollar analysis plays out with the violation of the dollar, I do feel like this snapback bull flag pattern on HMY can be gobbled up at 4.6 versus on AUY. I do not feel this downward movement pressure can be gobbled up because you're too tight against the breakout channel. That on AUY, you would wait for that to strengthen and then play the breakout on AUY. So for the, because I got a fairly similar reading on these two companies, if you wanted to be aggressive, I feel like the snapback bullish retracement on HMY with a doji upward movement price can be traded versus on AUY. I feel that analysis would lead to a breakout.
I agree. Obviously the difference in the two charts is how you possibly could play them as the price action develops.
The HUY chart is the cleaner chart. It would be the better chart from a swing to position style, where you're looking at a potential consistent trend going back up into 5.4 over the next 2 months or so, right? Versus on HMY, I do think you're looking at it more as I'm looking at this as a bullish retracement. I'm looking at this as a give me a doji type candidate followed by that upward movement in price. This feels volatility meets more swing trading mentality. And so if you're looking to swing trade and take the aggressive position on a minor, I do like a doji followed by an upward movement in price on 4.6. For those of you new to tackle trading, needs a doji means nobody in the history of mankind would ever simply buy the dip. That's not what the needs a doji means. Wait for the dip to subside, upward movement in price. And if you don't know what needs a doji means, you do need the step system. So go over there to tackle trading, get the step system, because all of this is step system mechanics. But HMI would fit that step system, bullish retracement, needed doji swing trader analysis versus AUY. I think you got the combination. I think it's because you have more consistency on AUY than you do on HMI, but I think both can be traded.
So the two of you brought gold mining stocks down here under $5.
Come on, make it
technical
3.
setups.
Make it 3.
I thought about it. Listen, I thought about it.
All right.
I'm going a different direction though. Give me CDEV if you can.
CDEV.
Yes.
Victory, correct? Yep.
Oil company, I know that we downgraded energy by 5 here, but very similar, kind of price action here on CDEV that we're waiting somewhat in the energy sector on. It had the correction. Now it's in this consolidation back and forth between about $3.80 on that pivot and 460-ish. Depends on where those tails are on your confirmation. It's a really, really simple trade. If you get the breakout above 4.6 confirmed, you can play it back up to 6, probably on T2. Where your T1 would be, you're probably using ATR assessments, something simple, a mechanic like that. You're going to be like $5 or $5. on your T1, then T2 would be at 6. I think you've got reward risk that you can make work. Okay. I believe that based on the math and the numbers, the swing trade setup there. What do you guys think? A little energy
This was
play
actually on
under
my
$5.
This was actually on my list. It has been a brutal 6 weeks for many stocks in the underbelly, many micro cap stocks, even some small cap stocks. It's been a brutal stretch. And when you look at the commodities, oil, a lot of the small cap and micro cap oil companies are not created equal. I have liked the companies that have formed consolidation patterns. If you pull up NEX, similar analysis, where you've came down, there's this brutal stretch in the whole space, and you start to form consolidation patterns, whereas other stocks continue to get hit. Certain stocks starting to level out and form some of those multi-week consolidation patterns. So I liked CDEV, same analysis on the breakout, same analysis applies to a NEX on a breakout. What do you think, Matt?
No, I definitely see it, and I do think swing trade here, and I do think you can. I mean, you're going to think 5 just because you think 5 all the time, but 5 doesn't really play a role in the analysis. The analysis in terms of targeting starts at 5, like really kind of $5 to $6. So if you're targeting, on your T1 5, it really puts it difficult to get a stop loss underneath the pivot point here. But with the 5-5 target, that opens the door to a little bit looser stop losses. The other thing that I'm seeing on CDEV, Tim, is the chart. It's not very clean on the trigger, but given what's been happening in energy and given what's happening in the underbelly, I think you'll take it. Quite frankly, like that's been a choppy, nasty disaster, and here at least you got some stabilization. The question for me would be on trigger. And when I'm looking at this chart, when you're looking at the intraday, you got top shelf here of 4.7 by 4.8 that you could trigger. But if you trigger all the way up there, that destroys your stop loss placement with where you need it to be. You'd have to go stop loss underneath breakout channel. And most likely stop loss would be in this choppy disaster of a mess. And so you don't want that. So I do think you got to be a little bit more aggressive, Tim, on your trigger. I don't think you can wait for ultimate confirmation here. But I am seeing a couple things to keep an eye on that you could be a little bit more aggressive. Now, a couple things. Number one, you're seeing the 20-period moving average here form, and you see that fight against that 20. Actually tested actually above that level right there, and it very subtly, you got a level of 4.5 that you can trigger above, given the fact that that would put you above the previous day 2-day confirmation. It would get you to close above the 20-day moving average for the first time in a month, and would break this somewhat neutral type pattern we were looking at over the last 3 weeks. And so couple the entire data here, I like a trigger above 4.5. It's underneath the ranges here. Ultimately, you would like to get it so you have all this clear error to the chart. I just don't think you can make R to R work there. I like a tight aggressive trigger above 4.5, discounting the wicks to the left. Get a stop loss underneath 4. That allows you to target 5.5 with a good R to R, and get you underneath at least the majority of the support pivot analysis. You couldn't get it under 4.75, but that was going to be, 3.75. That was going to be a pipe dream from the very beginning. But you can get that stop loss under 4. You can trigger above 4.5. Both are aggressive, taking it up into the 5.5 range. It can happen. It's aggressive, but the analysis is there for a swing trade.